Um, so this is going to be completely unstructured and unprepared. So apologies in advance, but I'll take kind of your guys' lead with what is interesting and where you have questions kind of in the space, on the technology, on the financial side, kind of on like the activity today. I think the only person who sent me questions beforehand was Ben, which were more on the regulatory side. So we have at least some interest there. But I mean, as financial engineers coming up, there's so many different ways in which like the digital asset space touches legacy finance that implicates, job opportunities and just like the way in which finance and macroeconomics are going. So there's kind of a lot of different angles that you could probably approach this from um, from a disrupting of what the existing financial landscape looks like. Um, Cryptocurrency is essentially posing the first threat to banks in a long time. So they're all rethinking their models. They're having to first kind of compete with this wave of fintechs that we've seen. So the Squares and SoFis of the space that don't necessarily have traditional banking licenses, or at least not at the beginning, but functionally operate by giving financial services to clients. And the banks, for many different reasons, have become cumbersome and haven't innovated, and their technology is very legacy. But at the same time, it's kind of like that double-edged sword. The reason why they're still here and why they haven't been disrupted is because the regulatory space is so complicated. They're super monopolized in a lot of ways. And the regulatory cost, the compliance cost, the cost of scaling up, all these things are such high barriers to entry, which is probably why it's solidified for so long. So that's kind of a ramble on just how digital asset space is causing disruption in finance just by its presence being there. But then there's the interactions between basically the decentralized, cryptocurrency space, but also the decentralized finance space, or DeFi space, directly competing or interacting with finance. So kind of there's many different layers at which to think about this. But I think it's pretty clear that there's a lot of disruption happening, and that it's important to pay attention to where things are and where they're going.
Yeah, I mean, what I wanted to say is, I think out of the students, right, I'm going to think that maybe a third of them, and in a third, I'm thinking with Selma, Brian, and Stephen, have started and working on some of these type of projects, and then I would expand to Ben and Michael and Kai-Su, who have worked with you, but it's kind of half of the population, where the other half are probably thinking, okay, well, blockchain, bitcoins, whatever, and I could keep on going, either for a bank or for whatever, or for your typical financial institution. But what you're saying and what I've seen is that, this blockchain is not going, it's not its own little, it's expanding, everywhere. And if you don't keep up with it in terms of jobs, right, you could end up working on, Wall Street for 10 years. And then they're going to say, you know what? We're not doing any more compliance. We're going to outsource this to some firm. We're not going to, you know what I mean? It could be a huge thing in the future, like things that we've seen in the past, like the iPhone and BlackBerry, right? Was just fine. My BlackBerry was great, and then he brought all these apps, which who cares about apps? Well, guess what? It's gone now. So my biggest concern for the students is I want to make sure that they don't lock themselves into because of what they see. They need to be forward looking, and that's why I think it's important for you to tell them, guys, watch out. This is not just right. There's something fundamental going. Is there stuff going on with companies themselves, like JP
Yeah.
Morgan and Morgan Stanley. And
Yeah, so banks are now, there's kind of like been multi stages of how the like very legacy traditional financial institutions have responded to crypto and blockchain. First, there was just kind of ignoring of it, then dismissing of it, and making fun of it, and then there was like this whole narrative of blockchain, the technology underneath digital assets is interesting to them because it can help them improve their business, but they don't care about Bitcoin. So the saying from a lot of the heads of banks was like blockchain, but not Bitcoin. But then now recently it's been, they've kind of realized, I think, that they need to catch up and, they're playing a different ball game. In a lot of ways, it's like, there's network effects at play here, and there's just like paradigm shifts of the infrastructure. So, I mean, if you think about going from traditional taxi cabs to Uber, where kind of everybody can work within a single framework rather than like a top-down hierarchy, that's massively disruptive. But imagine if Uber, which is still a private company, was just a protocol. It's a complicated protocol, but basically the same thing as sending a text message. That would disrupt even Uber. And we're kind of seeing those, like banking is getting hit by both that wave of like the Uber type companies that are taking advantage of the new tech, and being able to basically decentralize things for their users, and then also just protocol level or infrastructure level disruption at the same time. So yeah, excuse me. Does anybody have any kind of like very large scale topics or questions that they want to ask? So more from like the macroeconomic or financial industry as a whole side of things.
How are you seeing hedge funds trade like with the CME futures and Bitcoin a lot? Are you seeing a lot of that, or do you think a lot of money to be made there?
Yeah, so on the trading side, there's massive amounts of growth in terms of liquidity and just volumes that are happening, and also products that are being offered and used. I think like 3 or so years ago, we started seeing kind of like the first institutional grade trading firms coming up. So the likes of backed CME futures, as you mentioned, kind of coming on board. So a lot of players who had built really successful trading venues like ICE, which is backed, for example, all came into the picture, because before that it was, a couple of retail focused exchanges that didn't follow any of the standards that you see in finance with naming conventions and security reviews and things. So now those are pretty much all in place, and we've seen the volume pick up massively. So personally, like I've worked with hedge funds which have gone from trading only commodities to trading a little bit of crypto and dipping their toes in, to now being full-time only trading crypto. And the volatility is, it gets slammed down a lot in the news because of like the currency or settlement layer or store of value narrative gets disrupted by something that's volatile. But traders obviously love that. So, there's massive both margins in terms of volatility swings, but also massive margins in terms of the disparities within the market, and the opportunities that still exist for larger players to do arbitrage. So recently we saw like this spike 2 weeks ago, I think, or a week and a half ago. There was a massive like single tick candle down, and then it kind of continued. Obviously, the trend kept coming down, but especially on Ethereum, I think we went from something like we're hovering around 17 or 1800, and on one exchange, Kraken, which is a spot and derivative exchange, which is a US based company that's highly regulated and things, but pretty illiquid. there was a massive tick down that liquidated. It probably like went down to $700 or something in like a matter of a couple minutes, where that didn't happen necessarily all over the market. So it liquidated all the positions on that platform and then caused this ripple effect on other platforms. And you still see stuff like that happening, just this week.
You said that happened 2 weeks ago?
Yeah, I think so. I think it was last week or 2 weeks ago.
You think
Yeah,
that's
within the last 14 days.
because of what was going on with GME and AMC and them, or is that?
It's hard to say exactly like to what degree things have influenced each other. I think that there's been like this massive, the GME AMC GameStop thing is like important to bring up because it's brought a lot of people's attention towards trading and financial concepts like short squeezes and stuff like that. So there probably is quite a bit more retail interest coming in because of that, but also just independent from that.
How liquid is the lending market with most of these coins? Like, can you short them? Okay, can you like stuff like that? Is that and where do you do that? And what are sort of like transaction costs associated with that thing? And is there any margin requirements? I'm curious about that sort of stuff. Like, there's no,
so
obviously it's not even a security.
Yeah, so that's a really good question. And there's kind of like a multifaceted answer. Like it depends partly on your jurisdiction. It depends partly on like your technical expertise and your financial connections. So there's kind of those institutional grade platforms, which I previously mentioned, which offer products that let you, do lending or, take short side positions or enter into these contracts. So there's kind of that more typical side of things where there's just derivatives markets and things. Then there's central financial lending platforms. So there's companies like BlockFi, based out of New York, I think, that participate in both retail lending and borrowing, and also institutional. So what they will do is they have like an app where US customers can deposit funds collateralized in either Bitcoin or stable coins or other cryptocurrencies. And they will lend those out to other people who are, paying interest to essentially use this for financial activity. And then which also, by the way, yield something like 5 to 8%, which is pretty crazy compared to what banks offer you right now with, 0 to sometimes negative, US dollar denominated yields, and which is, tremendously low if you compare it to inflation. Anyways, so there's kind of like those centralized companies which are offering these, traditional lending services for either individuals or for companies at large. And then there's DeFi, or decentralized finance, which is the idea that you can just layer additional protocols on top of these decentralized platforms and basically construct via these smaller building blocks of code the entire applications or the entire transactions involved in doing those kinds of activities like lending. So there's platforms like Aave, AVAA. There's tons of different platforms. That's just the first one that comes to mind, that are built in this case on Ethereum, but also built on there's a Binance chain and tons of different blockchain networks that these things can be built on, which essentially let individuals enter peer-to-peer contracts with each other for lending or in aggregate. So all of us can deposit Ethereum to an address, which acts as a smart contract, which is basically like a liquidity pool where we all have our money in, and that acts as a automated market maker, or it acts as a lending pool. And then we can generate yield in these kind of more complicated manners. That second option, DeFi, that's long-term, really exciting. Short-term, really complicated, nuanced, rapidly changing, insecure in a lot of ways. So those users are typically more technically sophisticated individuals or small kind of new firms that, focus on only crypto. And the transaction costs for that are massive because you have to pay costs to the on-chain. If it's on like Ethereum, for example, Ethereum is a very cumbersome protocol. And when you make a really complicated transaction, like 20 of us all pushing money into a pool and turning it into some token, which then gets used in lots of different ways, it's going to cost us like, I don't know, a few hundred to a few $1,000s for initiating a single transaction like that. So you need to be doing a really good job, but the yields are so much higher in a lot of cases that it kind of counteracts those risks. I don't know if that's a good answer to your question, but
We had someone that came to see us not too long ago. Who was the name of Lombardi?
Yeah, I think that was his name.
Right? What's the name of this company?
I3Q Asset Management up in Vancouver.
Yeah,
That's right.
Nick, what that company does is it's essentially what you're saying is that they coming in and they do they offer financing to small. I mean, they're basically like a bank in a way. That's
Yeah.
scary because they're able to offer better rates. I guess because they don't have the infrastructure of the banks and it's secured and.
I mean, if you think about what's been happening, a lot of it's been happening kind of underneath our noses because like we get, an app that we view the bank through or we sit in a storefront. But when we're trading on a brokerage like Vanguard and we're keeping our money in a bank like Chase or Bank of America or something, and that's like all that we operate with is kind of like these traditional massive entities which custody our funds and do all of the financial services. The amount of money, the banks have gotten huge. The amount of money that they make on rehypothecating our assets, lending them to each other and other massive companies, and the amount of money that they make off of creating capital and credit and issuing debt is insane. And there's been almost no value capture for the individuals. Like, I think rates have only gone down in my lifetime. I've basically never had a positive yielding bank account. Maybe I've made like cumulatively $10 or something, and when I'm using a brokerage like Vanguard to trade assets, the majority of that business model has now become either selling of order flow or rehypothecation of custodied assets for making funds. And that's basically like the heart of the securities industry, which is kind of crazy. It's the way that the incentives have become after our system has gone along in this way that's created a situation like this for individuals where there's very little upside, but major upside for the institutions.
So basically it's our money, but they take it. This, it's exactly what's going on with Facebook and all the other guys where, they've got a business model where we are giving them our information and for free, and they use it, who owns the data? We should be paid for the information we give them instead of the other way around. So the advertisement. Jack, you were saying something last week. In fact, there was pertaining to this whole red, Robin Hood and all that. I think there was an article in Wall Street Journal that talks about, how Reddit actually makes its money, right? Because even though they don't charge anything to anyone, I guess they make the money through the order flow, right? So
for Robinhood, yeah.
For Robinhood.
Yeah, so they were kind of like the pioneers, or they were the ones who made this the new industry standard. Was commission-free trading, which sounds, what's the downside of that? Well, the downside is that the business still needs to make money, and the way that they make money, instead of just taking a flat fee or a percentage fee off of every trade, is by selling that trade to a high frequency trader who then takes a little bit of money off of you, and they get money through that relationship.
The price
Which-
that you're paying is not,
Yeah, so you're not paying the best price. You're necessarily being front run.
Yeah, going along with that, I've done research this and you know, potential solutions to this, and I think it was Mark Cuban tweeted something about how blockchain could be a potential solution to having a more accessible order book, if that makes sense. Is there viability to that idea? Could it be implemented soon? Because obviously, like, the payment for order flow thing has become a bit of an issue, especially for a retail trader. Just if you think you could speak on that.
So one of those decentralized financial applications that I was mentioning before, I mentioned Aave, which is a lending platform. Another one of those types of applications are DEXs, or decentralized exchanges. So there's Uniswap, SushiSwap. The interesting thing, and those are going to develop a lot more as time goes on. The interesting thing about those is the data for them is completely open, and the way that trades are placed is not through the same mechanism that we use today, where you have to use like a UI provided by a brokerage firm like Robinhood, which then, you know, interacts with a self-clearing entity, which then interacts with like the main settlement networks. And, you know, there's kind of like these layers, and you as the user are basically, you know, susceptible to any problems that happen because of that system, because you have to use those services to interact. Whereas these decentralized exchanges interact on open protocols, like on the Ethereum network. So you can audit not only kind of what's happening at the exchange level in terms of data. So you can see, you know, the number of people that are trading this pair, and when they're trading, you can set up your own alerts, build your own data companies like Inca has, and things like that to understand it, rather than having to go to those companies or be those companies to get that data. And then the other part is that they're executing on a basically a public infrastructure that anybody else could build on, audit, modify, you know, set up alerts for. So it's kind of a theoretical answer, but it's also, you know, kind of existing now. DEXs are currently slightly clunky, especially the ones that are on, there's kind of like this spectrum of more decentralized protocols and blockchains and less decentralized ones. And the more decentralized ones are, you know, more expensive to use, more technically difficult sometimes. And the less decentralized ones are cheaper to use and maybe easier to use. So there's a little bit of a trade-off currently going on in the space. And there's a lot of like discovery happening now for how that's going to pan out. Is that a satisfying answer?
Yeah. Yeah, I got you there. I guess my question is, my follow-up question to that is like, how do we know that these exchanges will be liquid, you know, if you will, when they're when they're not like we've known exchanges to be for the last 100+ years or so? I mean, that's not to say that exchanges we've had forever don't have problems. I think that the market maker and specialist systems we've seen before are not necessarily great. But like, how do we know though that they did have liquidity when it was necessary for the most part? So like, how do you like answer that when you're operating a more decentralized system, if that makes sense?
Yeah. So also two kind of different types of answers approaching that question from different sides. One is just that the kind of base infrastructure of these assets is so different than the types of securities and currencies and assets that, you know, all the infrastructure is built around traditionally. So rehypothecation of Bitcoin, only the people who are involved in that activity can get hurt, right? Because kind of some of those systemic issues basically can't exist in Bitcoin, or they can, but only kind of co-localized to where the activity is permeating. Does that make sense? As just kind of one type of answer. And then, sorry, can you just refresh me on the question slightly?
Like, how do we know that there's liquidity in these exchanges if they're not as, I mean, liquidity is a bit of a buzzword, I guess. It doesn't necessarily describe what actual liquidity is, but like, how do we know that there's going to be order flow?
Yeah. So we know that there is because of kind of how I said last time, the data is open. So the data is open, the protocols are open, anybody can audit them. So that's like part of what my company does, right? Is we pull all this open data, we analyze it, we say how much liquidity is there, where is it, what form is it in. So the fact that company can do that just using public data, that's pretty good too. I mean, when we go and we sell our data to companies, we can basically say that we have every single exchange happening on all these platforms, which is really difficult for a data company to be able to say. Usually you only get kind of derived metrics. So the data quality is really good in terms of its granularity. And what that shows is that there is massive liquidity in the decentralized financial kind of broad ecosystem. It's just that the liquidity is extremely pocketed, or it's dislocated from like each other. So there's massive centralized exchanges that are happening, and there's massive kind of over-the-counter markets that have formed, and then there's these decentralized protocols that have their own decentralized exchanges, and there's some interoperability, but there's a lot, and that's where currently there's a lot of opportunity, is kind of like these individuals or companies or hedge funds, which kind of serve as the bridge for managing liquidity between these things. But there is massive liquidity. It's just not yet kind of like broadly accessible, and you see like these ripple effects through the market where something happens like over here in this one place, and then the rest of the market kind of notices. So yeah.
And how are you? Quick question. I'm curious, how far do you think blockchain is on a realistic basis in providing a connection between the various parts of the world in terms of payment systems? I'll qualify that with an example. Like, how Drexel, the Drexel laid the first transatlantic connection sort of line in banking. How long do you see like blockchain being truly viable in use in that space, if I may ask?
Yeah, it kind of depends. I think that it's kind of a hard question to answer, because there's many different like ways in which blockchain has disrupted or is going to disrupt and cause these connections. So kind of just in the very baseline like settlement network kind of layer. So the ability to transfer value anywhere in the world and settle it without an intermediary, that already exists. Bitcoin invented that, and that has made massive changes that allowed my company to exist, and it allowed us to pay people in Russia, in Africa, in Asia, in the US, in South America, as a company of only like a handful of people, that let us operate, right? So and that already exists, and there's platforms that have bounty programs or connect workers or companies, and just basically use cryptocurrencies as the first that I'm aware of platform that lets you just trade anywhere, regardless of who you're trading with or sending money to and how. So that kind of already exists. It's not necessarily super adopted, and like the UIs have been getting cleaned up. So it's more of like a user experience side from that perspective. But the volumes in Nigeria, in Venezuela, in Argentina, in Peru have exploded over the last like few years, especially the last year. I think that there's like large premiums being paid by people who are locally transacting Bitcoin in Nigeria, something to the tune of like 20% premiums for purchasing side. So, and that's a regime that has come out regulatory wise unfavorably towards Bitcoin. So that's kind of like the first answer. And then on the financial services side, that's where it's going to take a little bit longer, because so with like this lending and accessing liquidity and all these kind of upper level services that banks have provided, those as I mentioned before, are kind of being serviced in multi ways. So there's these central companies like BlockFi offering opportunities, and then there's also these decentralized protocols that let you do these things, but those ones are more expensive and more technically difficult to understand and use. And those are going to be the ones that are only available worldwide, not caring about who you are. BlockFi is not going to let somebody from Nigeria or from Argentina open a bank account today, or an account with them today, and start, using your services. But those people can use a decentralized exchange, or they can use a decentralized lending market. So in terms of the timeline where we are at the stage of the first application layers being built, basically. This is kind of like the stage in the internet bubble where the internet had been built. People realized that anybody could just access anything online as long as there was an application built for it. There was all these companies that came into the space and tons of interest. That's kind of where we are right now in terms of decentralized applications, is like the first iteration of applications have all been built and are being worked on now. And then there's going to be massive improvements in terms of knowledge and security and usability on that side.
Hi, Nick. Just to follow up on that, you mentioned the example of trading volume boom in Nigeria, Venezuela, Argentina, and Peru. I noticed that they're really like a very crippling economy. Aside from having like a weak economy or maybe an unresponsive government, what's going to motivate more people to hop on the bus to participate in the blockchain movement?
Yeah. So the reason why those countries that I mentioned are specifically extreme or seeing extreme interest is because they're dealing with the same problems as everybody to the extremes. So any place where you're seeing inflation at a massive level verging on hyperinflation, it's extremely salient to anybody who's grown up in a regime like that or is living in one, that you need a way to store your wealth, right? Like you work for your life, and the idea is that you need a way to preserve that so that you can then do larger things like purchase a home and pay for a medical bill and send your kids to college and stuff. And so if your currency or the only legal mechanism of storing your value is in the fiat currency issued by your government, and they print 100% a year, then after a handful of years, your money looks like it's back to square one. So in countries experiencing massive inflation, where every week it's noticeable that their wage purchases less and less groceries, it's just obvious, and everybody's looking for something to store their value in. So traditionally, people have tried to get their hands on US dollars, but with the M1 supply in the US basically exploding over 2020. And for those of you who haven't heard of Michael Saylor, he's a CEO of a company called MicroStrategy, which recently put their balance sheet, the company balance sheet, into Bitcoin. He's articulated this point a number of times, which is that the cost of capital even if you're in the US, a working financial system, the cost of capital is now like 20 something percent. It used to be pretty fine to, if you're operating a profitable business, deal with the fact that your capital basically stays the same. If you put it in treasury, you put it in a 10-year treasury note and you make 3%, probably lose a little more than 3% to inflation, but it comes out to around even. So you're kind of stacking up wealth as you make money and keep operating. But if your money is losing 15 to 20% a year, you're going to look for a way to, put it in something that doesn't lose its value. So from that perspective, it's extremely just looking for something that stores wealth and has liquidity and has properties that let you transact with it or divide it. All these properties that Bitcoin and other cryptos have. That's just very attractive to anybody who wants to store value. And we're in this macroeconomic landscape where there is no like safe parking spot like there used to be, where basically the go-to was individuals could just hold dollars, companies could just hold treasury notes, and it was kind of easy.
Yeah, and with all the money that we're printing in the US, that's interesting what you're saying. That so not only is the financial system in question, now even the dollar as a reference currency at some point might be because we're printing the market is awash with liquidity, which is probably why the stock market is so high, and it doesn't represent. Okay.
I just
Yeah,
want
we're
to get
basically
your
seeing asset inflation. Go
I
ahead.
just want to get your like opinion on something, Nick. So like, what do you think is the best way to like moving forward to kind of make blockchain understandable and like usable for like all developers? Because nowadays you see people with like crypto saying like Dogecoin to the moon and stuff like that, but I feel like they don't really understand the tech or backing behind it. So
yeah, that's a good question. So first, it's just on Dogecoin. It's a great meme, but security wise, it uses something called like I forget what the technical term is. It's like proof of ancillary or proof of auxiliary or something. It basically uses Litecoin to secure it. So it just proves that there was proof of work happening on a different chain, and then basically double uses that. So it makes it economically more viable to attack that base network to try and double spend on both. So security wise is an issue for Dogecoin. Distribution of funds holding and admission schedule in terms of inflation are also problems for holding Dogecoin. So you're completely right in terms of that not necessarily being a super viable option, which makes education extremely key and also really difficult because it's super technical. And now that people get to make decisions rather than just having a single currency and like a handful of, licensed banks that they can operate with, they basically weren't making any decisions for themselves, right? The regulators basically told them what markets they could operate in, which ones they couldn't, whether they were smart enough to make, a VC investment or not by accrediting them. So now people can make their own decisions. And there's going to be a lot of disinformation out there because there's, financial incentive to try and get people to buy your token or to, buy the token that you hold. So it's a big problem. And I just think that there's no like silver bullet for it. It would be good if it started being, picked up in the curriculum at not just colleges, but in high school. I think we just we kind of need more like educational reform in general. Like there should be some personal finance that everybody high school learns. I would have benefited from that. And just kind of learn about these concepts generally and familiarize people with it. But nobody's going to be an expert in not everybody at least is going to be an expert in crypto. It's just too interdisciplinary, too complicated, just like economics was beforehand. Like people went to finance and learned about finance and learned about economics because it's super complicated as is. So crypto is no different than that. It's just new, more complicated, and so on.
I have a quick question. So as like Bitcoin cryptocurrencies are becoming like more and more popular, especially over the past few years, I'm curious like what you think the biggest like technology or security concerns are and how you see the regulatory landscape changing over time.
Yeah, that's a great question. Really broad, hits on a lot of also kind of hits on a lot of Ben's questions that you messaged me. So maybe first it's important to talk about the regulatory landscape just in general. So within the US, which is one of the most complicated financial and economic like regulatory regimes, there's a massive amount of overlap, jurisdictional overlap between different departments basically. So there's, you know, if you think about, you know, there's the IRS, there's FINRA, there's the OCC, there's the SEC, there's the CFTC, there's all these state level organizations, there's all these banking specific organizations, and all of their jurisdictions slightly overlap with each other. And then cryptocurrency comes along, and it's hard to even just define, you know, what Bitcoin is. You know, the IRS taxes it like property. The SEC gets involved with cryptocurrency cases. The CFTC does. The, you know, FINRA decides whether or not like different banking transmission laws are going to have to apply to it and how they apply to businesses that interact with these products. So it's just massively complicated. It's a really difficult space to navigate from a compliance and legal perspective within the US. And other countries don't necessarily use the same framework as us. So in Canada, for example, there is no kind of like SEC, CFTC differentiation on the regulatory side. All the markets are kind of, you know, managed by just the different provisional or province kind of level regulatory bodies. And in other places like, you know, a lot of the smaller islands and smaller European countries, there's like a single monetary authority that does everything. So that's a super important thing to just kind of understand, because and it matters which department is making comments or making action within the US. You know, it's with regard, like when the SEC makes a decision, or the CFTC makes a decision, or FINRA makes a decision or a statement, you have to kind of contextualize it with what their role is within the regulatory framework. So I'll stop at that, make sure that there's no questions, and then we can talk more about like the disruption or where it's going.
Yeah, that makes sense. And then, so for like cryptocurrencies, do you think different countries are going to have like different regulations for it as well, like the US has, as compared to like other securities?
Yeah, and I think within countries, there's going to be not consistent regulation. I mean, within the US, it's already really different depending on what state you live in, or what state you're domiciled in. The way that Wyoming treats and understands cryptocurrencies and cryptocurrency related businesses is very different than New York or Colorado or wherever. We already have banks, virtual currency businesses that have gotten banking licenses in states like Wyoming. And then we have things like the BIT license in New York, which requires an extra, essentially massive level of regulatory compliance for any business operating in New York. So it depends a lot on what state you're in. And there's going to be a lot of regulations which have implications for businesses that don't have implications for individuals as well. A lot of the like money transmitter obligations that, you know, for anti-terrorist financing and anti-money laundering that apply to a business that's accepting or selling cryptocurrencies is going to be really different than, you know, those of us who use it more like a Venmo. Yeah, it's also just going to be changing the way that these regulators operate in a lot of ways. And what I've seen from kind of being involved in the industry and working with these regulators is the ones who are more, you know, just interested in understanding it and kind of like interested in innovation rather than just kind of rules based and super strict and not really caring about what they're regulating, just looking through the lens of their existing frameworks. Those ones end up taking on more responsibility. So the CFTC is probably more prominent within the industry for those businesses operating within the industry than the SEC, even though it might be counterintuitive in a lot of ways. So I don't know, there's kind of a lot there, and I don't know if I can give like a non-complicated answer, but we can, yeah.
Yeah, and to your point, Nick, I mean, when you look at Yellen, you know, in terms of what she does and what she was doing before, it feels that it's the same people, right? They're recycling the same people throughout various administrations. You know, from Yellen to the previous one to Bernanke, and they used to work together. So I feel that, and they missed completely 2008. And this is when, you know, blockchain started to come around. So I don't know, but at the same time, they've got the power today, so they're not going to let it go that easily. But it feels to me like something is chipping away at this entire system, and I don't think we people, you know, it's even tough to come up with a question because you say, well, I'm sorry, what's really going on? Is my bank account say everything is okay? Nothing is changing, right? I don't know. I mean, something is chipping away, and we better be aware of what it is. Especially, you know, these guys and Yerevan, I mean, they're going to be looking for jobs in that industry. It's like you, I guess it happens before, several times before, where the cycle change, and if you don't change with it, right, you get left behind. You know, like people still not driving an electric car, right? And figure, well, it's never going to work. I don't know. They're going to do away with the regular car eventually. I mean, there's stuff happening. It's changing very quickly here. And I don't know if we're educating enough, frankly, when I look at the curriculums and look at everything else. It's the same thing. Yes.
I wanted to ask you a question sort of on that idea of education. And quickly here, Nick, courtesy of your time, kind of in traditional finance, you know, we've seen PhDs and practitioners come out with literature that's then sort of applied at banks and institutions, you know, factor modeling, Markowitz optimization, stuff like that, right? I feel like on sort of the crypto and the blockchain side, right, of things, it's coming more from, instead of coming from the academics into practice, it's coming from practice into academics. At what point does that dynamic change? And kind of in your opinion, right, if you have a bunch of PhDs, you know, sitting around top institutions studying these things, is that going to be able to convince the public and or the regulator and or the banks, right, that this stuff is indeed okay to be using on an everyday basis, right? And to that, is it going to make it more accessible, right? I feel like when factor modeling first came out, when they first won the Peace Prize, everyone's like, oh my God, right? And now it's kind of like people used it for 10 years and now they're kind of going away with it. And machine learning from the academics is now making its way, and this NLP stuff is starting to make its way into the industry. Is that dynamic going to be changing from, instead of the actual private companies developing and researching, right, to now academics researching and kind of filtering that into the pipeline? If that kind of question kind of makes sense.
Yeah, the question makes sense. So this observation that the industry and like kind of the engineering side has driven the scientific and research side is really interesting. So you see like a lot of just developments happening on either open source or through dev companies like Electric Coin Company or IOHK. They publish papers as they're engineering, basically. They're coming up with new cryptographic functions that they just require for their protocols. So it's driven a ton of innovation, and that innovation has required basically documentation, and that's where that research comes in. We do also see really high quality institutions starting to, I mean, you guys have a blockchain course there, right, that Hank teaches. MIT is massively involved in producing research. I've interacted with a bunch of universities on either research proposals or just talked with economics professors at a lot of research universities that are spending all of their individual effort on researching this space. So it is now like being done basically at the top level research or entities. I kind of forget the other part of the question that I had something to say.
I guess in essence, when are the banks, I guess as that continues to develop, right, or even in the short term, where we've seen the MITs and then the Caltechs and the Georgia Techs, right, do all this research, are the banks being receptive to it, or are they kind of holding it back and saying, well, we need more time to understand it, et cetera, or is it kind of instantaneously being, you know, okay, this makes sense, let's go ahead and deploy right to our clientele?
Yeah, I think it for banks themselves, it's kind of complicated, and I think they have like a lot of their own internal kind of research departments, and at a high like decision level, they're kind of decide, like a lot of it kind of happens top down in those organizations, and you know, they probably don't necessarily know exactly how they're going to get involved. So a lot of them have spun up like research into using blockchain basically as an intranet for their own infrastructure and stuff like that. So, and then some of them are, sorry.
No, go ahead, I apologize.
And then some of them are researching more from like a custody side, and like, how do I, so it kind of goes in lots of different directions. So it kind of depends institution by institution. But at a regulatory level, there is interest from the regulators in what academia says and what they're doing. And I have been involved in a handful of conversations and projects where regulators basically want to work like in sync with universities and companies operating within the space. And there's a lot of research efforts that kind of involve universities with enforcement departments to make sure that what they're doing actually makes sense. So there's kind of like this outsourcing of the technical understanding to universities to some degree from government.
So at least on the banking side of things, right, would you say that from a product lifecycle perspective, this is still, when I say this, it's more, I'm referring to sort of the implementation and kind of like the widespread usage of it. Is it more, we're still in kind of that proof of concept phase?
Maybe from the bank's perspective, yeah.
From the bank
but
perspective.
kind of like as a baseline settlement thing, it's like already happening.
Yeah.
And then it's like, do the banks jump on board? Do the banks try and compete? And exactly from their perspective, it's kind of like, okay, here's this new thing that exists. How do we, what do we do with it? Do we do anything with it? And so on.
Understood. Thank you very much.
Yeah, but you know what? First of all, I agree with what you're saying is that obviously the heads of various banks have to understand what's actually going on. Okay, that's one. But then at the end of the day, but their business model maybe doesn't lend themselves to this type of business, right? It's I own your data. Well, blockchain is everything is decentralized. How could they, unless you keep the name but you change everybody inside and it's not the same bank anymore? I mean, I'm sure they try to understand the technology. I mean, if they do understand, they're going to realize, oops. I mean, that means that we everybody owns their data, own their money, everything else, and we're not designed. We were not designed for this originally.
Yeah, they're basically going to have to realize that they're going to be competing against this, or they're going to have to completely adapt and
Exactly.
just change their entire business model
Wow,
around it.
that's a huge undertaking for institutions that have been around for like hundreds of years, right? Okay, stop making combustion cars, start to make electrical car. Okay, well, that's what the Cadillac did, right? So, and Ford. The only thing is, if you want to go cross country, good luck. There is no supercharger like with Tesla. So you get 30 miles an hour as opposed to Tesla gives you 256 miles an hour.
Yeah.
So yeah, we've got electrical cars, but you really can't do much with it.
But and I think with kind of like a lot of massive disruptive innovations, this is like the way that you see it, right? Is somebody understands it and uses or adopts the technology from outside the industry that it's disrupting. So like, Tesla came along as a new company. It wasn't like General Motors that came out and produced a Tesla line, and then then Tesla kind of front runs everything, and then eventually some of the legacy adopts and innovates. But that's kind of with every innovation, is like there's the new players who completely understand it and show this new vertical, and then the old players potentially get involved.
Yeah.
And
So I'd rather my student go work for Tesla than GM or Ford, and hopefully they get it. And if they don't get it, oops, they're going to be interesting.
Hey, Nick.
Hey.
Hi. I was sorry. I was a little bit late into the meeting, but I don't know if you touched on this already, but I would very much like your insights on the transaction speed for blockchain, because I don't know if I understand correctly, like at the current speed, like it's not on the same level as our need for transactions, only like less than 10 transactions per second. So what are your insights on like the limitation of the transaction speed as for the viability for this technology?
So that's a good question. So the transaction speed, it kind of depends what you're comparing it to, because when you send a Venmo and it almost instantaneously shows up on your friend's screen, it's not like the entire transaction has actually all cleared and settled. And what you're sending is the person knows that it's coming, but it still has to clear through the banks and the fintech companies, right? So it's kind of unfair in some degrees, the comparison that many people make between like a Venmo or a PayPal versus Bitcoin, or a credit card company versus Bitcoin, because there's kind of this massive process happening in the background that deals with the clearing and settling. So Bitcoin kind of acts as a settlement layer, and once it's confirmed, it's confirmed. So there's that. And then if you think about Bitcoin acting as the settlement layer in, I guess, opposition to this layer of clearinghouses and banks that are settling between each other, then you can also think of, instead of these fintech companies like Venmo and PayPal operating on top of them that allow these instantaneous like user things, there's also things built on top of blockchain. So there's second layer solutions. So on Bitcoin, there's something called Lightning. There's also something called Liquid, but Lightning basically lets you do that instantaneous transaction, and then it settles onto the Bitcoin blockchain. So in a lot of ways, blockchain will enable faster transactions on the settlement side, and initially a lot slower transactions from like the user side, until those L2s or those layer 2 solutions are fully kind of built out, and until like blockchain gets actually adopted as a settlement layer. by other applications. I don't know if that's the most clear way I could have verbalized that answer, but there's kind of like a incongruent comparison that happens a lot of the time with transaction speed. And then Bitcoin is like the slowest blockchain of all of them. It's just the most secure, but slow and heavy. So there's a lot of blockchains that do have much faster confirmation speeds and settlement and stuff, but there's a trade-off there because it's, you know, more like sending a bank wire that could get reversed or there's an issue with it or something.
Great. If there are any more questions for Nick, thanks a lot for your time. That gets me thinking about we need more of these projects somehow to funnel through the curriculum because there's a lot of things going on here, obviously.
Yeah,
I
this
just
has
have
been
to-
super fun. Thank you guys.
Yeah, Michael.
Oh yeah, go ahead.
So relating to the article that Professor Zorro sent, like, what's your opinion on these big companies using debt to finance like cryptocurrency purchases? Like, you have in the article, they're talking about MicroStrategy issuing debt to purchase like $1 billion of Bitcoin. Like, what's your take on that?
Yeah, so it's a less obvious than just putting, you know, your existing funds on the balance sheet, raising debt. I think if you just think about kind of like the macro perspective that we laid out with, you know, fiat currency debasing very quickly and Bitcoin being a potential store of wealth, if that thesis, you're 100% bought on it, then issuing debt to buy Bitcoin is like free money. So I understand why companies are doing that. You know, that's an assessment that they individually have to make. And obviously most companies are on the end of not even wanting to touch Bitcoin. And then Michael Saylor has 95% of his balance sheet on it and is issuing debt to constantly buy billions more. So some people are going to see that as reckless. Some people are going to see companies that don't put anything on their balance sheet, Bitcoin or cryptocurrency on their balance sheet, as also reckless. Probably something in the middle makes more sense. You know, that's I guess my take. But at the same time, like, he's issuing debt for these convertible notes, right? That's allowing, he's kind of like giving the opportunity for other people to get skin in the game. It's not like just him going out, taking on, you know, spending all of his student loans on Bitcoin. It's a slightly different scenario. Yeah.
Okay, that was interesting. A finale here. Nick, Director of Research at Inca Digital, thank you very much for your time here.
Thanks so much, Pat. Thanks, guys.
And next time we meet, talk about where they are with their projects, because we're getting close to the end of the semester.
Awesome.
Thanks again.
Take care, guys.
Okay, bye-bye.
Bye.
Thank you.